I want to congratulate Abhidan Mehta and his team for conceptualizing, excellent workshop on anti-abuse provisions. This pre-recorded video will give head start to the participants in understanding basic concepts, and I'm sure they will be able to participate in the workshop more effectively. Very briefly, I'll touch about the CTC and I'll introduce CTC to you all. CTC was established in the year 1926, so we are in the 97th year of our existence. We have members around 3,700 members, which comprises of lawyers, chartered accountants, and other professionals. Also, student members we have. Our membership is on a Pan India basis, so almost all the states, we have our members. In terms of activities of the chamber, we do programs on contemporary topics. We do regular RRCs, residential refresher courses, study circle and study group meetings. We also come out with a monthly journal on a direct tax, which takes various topics and in-depth analysis of those topics are covered in that. We also come out with quarterly journal on international tax and quarterly journal for students, which is known as Jigyasa. We are very active in representation to various government authorities. So this is very briefly about the chambers and its activities. Those of you who are not the member of chamber, I invite you to become members and take active part in the activities of the chamber in whichever way you can. With these words, wishing all of you happy learning. Thank you.
On behalf of Chambers of Tax Consultants and Direct Tax Committee, we welcome everyone to this virtual advanced workshop on anti-abuse provisions under the Income Tax Act. As far as so basically in this workshop, we intend to cover the history, the background of all the gift tax provisions, section 52, section 56 provisions, 50C, 50CA, 43CA, and the fair market value based taxation. So with this, we have, as far as the structure is concerned, we have CA Vinod Ramachandran, who will be giving us the brief background, the history and overview of all the provisions. So this will be a pre-recorded session which will be shared to everyone, and then we have our advanced workshop which is scheduled on 7th and 8th of October. The details of the sessions and the registrations details are available on CTC's website. So with this, we first, on behalf of Chambers of Tax Consultants and Direct Tax Committee, we would like to thank CA Vinod, who accepted our invitation and agreed on giving us the history and overview of these anti-abuse provisions under the Income Tax Act. I think with this, would ask Chirag to give a brief intro of the speaker today.
Thanks, Viraj. Very good morning, everyone. I've been given the pleasant task of introducing today's speaker, which is Vinod Ramachandran. Vinod Ramachandran is a part of Direct Tax Solutions, Knowledge and Solutions team of EY India, which is based out of Mumbai. KNS is a group dedicated of tax professionals that provides technical support to the internal tax practice and is engaged in developing tax solutions and strategies. Vinod himself qualified as a chartered accountant way back in March 2014. He has around 8 years of experience in corporate tax and international tax. Prior to joining EY India, he worked across with Umesh K. Gala and Associates. With this short introduction, I'll hand over the dice to Umesh so that he can take ahead the presentation here. Thanks, Umesh. Thanks, Vinod.
Thank you, Chirag. Thank you, Virag, for the kind introduction. So, to set a brief context to this session, CTC has planned a very detailed program for anti-abuse provisions, and the purpose of this session is only to give you a history and an overview, a flavor as to what are the provisions and what are the nuances behind those provisions, let you know of some typical issues which may arise, so that a stage is set for a more detailed learning, for a more enhanced experience. When the final session happens, the issues will be answered by speakers, by expert speakers who are there. I am here only to provide you a broad background, history, and an overview of the provisions. With this, let me start by telling what will be the contents of today's session. We will start first with 56.2.10 by understanding what was the legislative background behind 56.2.10, which were the provisions which existed in the statute before 56.2.10 was introduced. Then what was the change which came in after 56.2.10, and then we will delve into each component of section 56.2.10. We will understand each component of the charge in greater detail. Then we will also cover very small discussion on the exclusions in section 56.2.10, and then after that we will proceed to section 50C, 50CA, and 43CA, and we will end the session with a overview of Rule 11 UA. With that, now let us begin with the history and overview of section 56.2.10. Section 56, before section 56.2.10 was introduced, you had the first provision which came in the Income Tax Act for taxing gifts was 56.2.5. It was introduced by the Finance Act 2004, which said that if an assessee who is an individual or an HUF receives any sum of money from any person without consideration means he is receiving the sum of money as a gift, then that sum of money will be chargeable to tax in the hands of the recipient, which is the individual or the HUF. Then we had section 56.2.6 to supersede section 56.2.5. Section 56.2.6 said that if an individual or an HUF receives any sum of money from any person or persons, so when you had 56.2.5, it was received a sum of money from any person, and the limit for each person was 25,000. When 56.2.6 was introduced, the limit got increased to 50,000, and it was for all the persons combined from whom the individual or the HUF is receiving a gift. And of course, there are some exclusions or there are some exceptions which were introduced, and the most popular exception being received from a person who is a relative of the individual or the HUF. Now let us understand why this provision was introduced. The Finance Minister, in his speech while introducing section 56.2.5, said the following on the floor of the Parliament. He said that honorable ministers are aware that I abolished the gift tax in 1997. That decision remains, but a loophole requires to be plugged to prevent money laundering. Accordingly, purported gifts from unrelated persons above the threshold amount of 25,000 will now be taxed as income. What it says is that this is a provision which is introduced to prevent money laundering. So what it says is that if you are receiving a gift from an unrelated person, regardless of whether the gift is genuine or not genuine, this amount will be taxed as income in the hands of the recipient. The explanatory circular says that this provision is introduced in order to curb bogus capital building and money laundering. So what is this focus around money laundering and bogus capital building? Way back in around when the provision was introduced, gift was used as a tool for money laundering to convert unaccounted cash into legitimate income. Unaccounted cash was given, sent abroad, and received back through banking channels and declared as a gift. You would recollect, fans of Rajnikant would recollect that this happened in Shivaji movie, where cash was sent outside India and it came back into India through donations from NRIs. Similarly, 56.2.5 was introduced to tax these gifts which are received from unrelated persons. One case before Bombay High Court shows us as to what kind of money laundering used to happen. So in this case before Bombay High Court, in case of Rajrani Gupta versus DCIT, the SSC received substantial gifts from NRIs, and these NRIs who were gifting this amount were unrelated to the SSC, and they were sailors of a ship and it was claimed that these sailors are gifting to the SSC out of love and affection. On facts, the High Court found that the gifts were not genuine and none of the donors appeared before the court, and the addition was made under Section 68. Because of Section 5625, now it is no longer a requirement to prove that the gift is bogus or the gift is not genuine. Any gift, even if it is genuine, if you have received it from a friend or your unrelated person, then that gift is taxable in the hands of the recipient. Now let us moving further to the subsequent successor provisions. Then we have Section 5627, which was introduced from the Finance Act 2009. 5627 said that insofar as an individual is receiving a sum of money as a gift without consideration, this provision was already there on the statute. The scope was expanded further to say that if an individual or an HUF is receiving specified property or an immovable property as a gift without consideration, then the fair market value of what you receive, being the specified property or the immovable property, will be taxable in the hands of the recipient. For specified property, the scope was defined as to shares and securities, jewelry, archaeological collections, artwork, etc. Then for specified property, there was a further condition which was added, or a further qualification which was added, that if you receive a specified property for inadequate consideration, then the difference of the price that you have paid for receiving the property and the fair value of the property that you are receiving, which is basically the benefit that you enjoy or the discount that you enjoy, will be taxable in your hands. So if it is received without consideration, the full amount was taxable, and if you receive it for inadequate consideration, then the difference between the consideration that you pay and the fair value of what you receive is treated as income in the hands of the recipient. Then these were the provisions for Finance Act 2009. The scope was further expanded in Finance Act 2010, where the scope of recipient was added to include a firm or a closely held company. For a closely held company, it is defined in Section 218 as a company in which the shares in which the public is substantially interested. That is for a widely held company. Any company which does not meet the definition of 218 is a closely held company. So where a firm, so what does 5627A say as introduced by the Finance Act 2010? It said that where a firm or a closely held company is receiving shares of another closely held company, and this is either without consideration as a gift or for inadequate consideration, then the benefit which is enjoyed by the recipient is taxable in the hands of the recipient. Then for finance, then we had some further amendments. In Finance Act 2013, it was realized that for immovable property, what is taxable in the hands of the individual or HUF is only if he receives the immovable property without consideration. If he receives the immovable property for inadequate consideration, that was not subjected to tax before Finance Act 2013. The scope was further widened to say that if you receive an immovable property for inadequate consideration, then the difference between the consideration which is discharged and the fair value of the property which is received is taxable in the hands of the individual or HUF. So for how was the fair market value determined? For immovable property, the fair market value was the stamp duty value, and for specified property such as shares, securities, jewelry, etc., the fair market value was determined as per Rule 11UA. For equity shares, broadly it was the book net worth which was considered as the fair market value. And then there were so while the provision taxes levies tax in the hands of the recipient has to be individual or HUF or a firm or a closely held company, but the giver can be any person or persons. After that, So up till now we had 56 to 6, 56 to 7 and 56 to 7A. These provisions were applicable for any gift or for any receipt before 1st April 2017. From 1st April 2017, you have a very sea change in the gift tax provisions. Say for example, before going to 56 to 10, let us illustrate what is the impact of 56 to 7 or 56 to 7A. So if an individual or an HUF receives, say for example, if he receives a jewelry whose fair value is say 10 lakhs, and if that jewelry is received as a gift, then entire 10 lakhs is chargeable in the hands of the recipient. If he pays an amount for purchasing the jewelry, say for example, if he pays an amount of say 6 lakhs for purchasing it from a friend, then the benefit which he has received is 4 lakhs, and 4 lakhs is taxable in the hands of the individual who has received the jewelry. With this, we will understand what was the rationale behind the provisions of 56 to 7 and 7A. The explanatory memorandum to Finance Bill 2010, when 56 to 7A was introduced, it said that these are anti-abuse provisions, and the rationale which applied for introducing 56 to 5 or 6 on the statute of money laundering, that rationale was again repeated when it came to 56 to 7A or 56 to 7. The explanatory memorandum said that the provisions of 56 to 7 were introduced as a counter evasion mechanism to prevent laundering of unaccounted income under the garb of gifts, particularly after abolition of the Gift Tax Act. Then it said that in order to prevent the practice of transferring unlisted shares at prices much below their fair market value, it is proposed to amend this provision to include within its ambit transactions undertaken in the shares of a company where the recipient is a firm or a company, not being a company in which the public are substantially interested. So what it said is that if there is unlisted shares which a promoter group is transferring the unlisted shares, if they say the fair value of those unlisted shares is 100 lakhs and you're transferring it for say 80 lakhs, balance 20 lakhs you are receiving it in cash. What the provision says is that the fair value of the person to whom it is transferred, says promoter group A is transferring to promoter group B, and the consideration which is paid by promoter group B is 80 lakhs, whereas the fair value of that is say 100 lakhs, or the 11UA value of those shares, fair value I mean to say 11UA value, or the book net worth of those shares is 100 lakhs. What the provision says is that the differential of 20 lakhs is a benefit which is enjoyed by promoter group B, and that benefit is taxable in the hands of promoter group B. So this was the story behind 56 to 7 and 7A. Let us go further to understand what is the provision of 56 to 10. 56 to 10 said that where any person receives in any previous year. So when earlier when the scope was restricted to an individual, individual or an HUF, or a firm or a closely held company, individual or HUF had to receive these 3 types of assets. Firm or a company, it was applicable only if the firm or the closely held company received shares of another closely held company. Now, what does 56 to 10 say? 56 to 10 says where any person, not restricted to individual, HUF, firm or a closely held company, it says where any person receives in any previous year from any person or persons on or after 1st April 17, what is received? It can be any sum of money received without consideration, which is any sum of money received as a gift, or any immovable property received without consideration or for inadequate consideration, or it can be any property other than immovable property. With this, property was defined to mean those specified properties which were already enlisted in section 56(2)(7). And this property, say for example, shares, securities, jewelry, etc., is received without consideration or for inadequate consideration. So let us see what is the enormous reach of this provision. What is the impact of introducing the words any person receives from any person? Say for example, if an Indian listed company is there, say Reliance, which is purchasing shares of another Indian listed company, say Alok Industries. Now in this example, a listed company is receiving shares of another listed company. The provision 56(2)(10) will need to be evaluated to determine the consideration which Reliance is paying, whether it is equal to the fair market value. If it is less than the fair market value, then the difference between the fair market value and the consideration which is paid by Reliance to purchase the shares of Alok will be taxable in the hands of Reliance. Then it says that if assuming Reliance were to purchase the shares of an unlisted company. So earlier the provision was not at all applicable to Reliance, because all you had is the firm or a closely held company is receiving shares of another closely held company. Reliance was a listed company and 56(2)(7) never applied to Reliance. Now for 56(2)(10), that argument no longer survives. What it now says is that where any person which is a listed company like Reliance is receiving shares of either another listed company or shares of an unlisted company, say Reliance is purchasing shares of Netmates, then you have to evaluate whether this provision is applicable to you. Then it can even cover Reliance purchasing shares of a foreign company. Say Reliance is purchasing shares of Hamleys, which is headquartered in London. Reliance will have to examine what is the fair value of Hamleys, what is the rule revenue value of Hamleys, is it purchasing this at a discount? If it is purchasing it at a discount, then the difference will be taxable in the hands of Reliance. It can also apply where a foreign listed company, say for example Amazon, is purchasing shares of an Indian listed company, say Future Retail. So a foreign listed company purchasing shares of an Indian listed company, there is no exclusion. Similarly, if a foreign listed company, say Google or Facebook, is purchasing shares of an Indian unlisted company, again there is no exclusion. Say for example, if Facebook is purchasing shares of Jio, then it is not still there is no exception in 56(2)(10). You will have to again evaluate whether there is any benefit which is enjoyed. Let us now evaluate. This is so far as any person is concerned. Now let us understand insofar as the firm or a closely held company is concerned, where the taxpayer is a firm or a closely held company, how did the provision impact you? So earlier the provision impacted you only when a closely held company was purchasing shares of or receiving shares of another closely held company. Now what the provision says is that if there is any closely held company like Serum India, which is purchasing not only shares of another closely held company, it might purchase immovable property for setting up a factory. It might purchase a house which is to be occupied by the promoter or the employee. It might purchase debentures of another company, or it might invest in debentures of another company with a view to eventually gain control over that company. Such a receipt, Serum will have to now evaluate under 56(2)(10) whether the price which is paid is inadequate as compared to the fair market value. So far as we concerned, we understood an Indian listed company, a foreign listed company, an unlisted company in India. Now let us say if there is an Indian subsidiary of a company which is listed abroad, say Microsoft India. Now for Microsoft India, if Microsoft India is purchasing a piece of land for setting up a factory or for housing its employees, Microsoft India will now have to see whether this immovable property is purchased without consideration or for inadequate consideration. Whereas earlier, you never had to examine this because it applied only for receiving the shares of another closely held company. So with this, one is puzzled as to why the legislature felt the need to expand the provision so much. Let us see what the finance minister said in his speech. It said, under the caption is important. The caption says additional revenue mobilization and anti-abuse measures. It said that under this caption, it was said that it is proposed to widen the scope of section 56 to provide that any money or immovable property or a specified movable property received without consideration or with inadequate consideration by any person subject to certain exception and exemptions shall be taxable if its value exceeds rupees 50,000. So it is to propose to widen the scope, and it is for revenue mobilization and anti-abuse measures. Which of the two prevailed, we don't know. Then what does the explanatory memorandum say? Explanatory memorandum says that in order to prevent the practice of receiving sum of money or property without consideration or for inadequate consideration. So it presumes that there was an anti-abusive practice which was going on, tax evasive practice, where sums were exchanged in cash and not through banking channels, and therefore it is this practice which is sought to be plugged in by introducing the gift tax provision. So it is this practice to say that in the hands of the purchaser, if he is receiving any benefit, if the fair value of what he receives is more than the consideration, then the difference is taxable in his hands. This is to prevent the practice of receiving without consideration or for inadequate consideration. Now there is an issue that, can you say in this, insofar as the Finance Bill 2017 and the explanatory memorandum is concerned, there is no clear indication as to whether this is an anti-abuse provision or whether it is for an additional revenue mobilization. But when 56(2)(10) uses the same words and the same phraseology which was adopted earlier in 56(2)(7) or 7A, or earlier in 56(2)(5) or 56(2)(6), can you say that the legislative intent which prevailed then is as equally applicable when it comes to 56(2)(10)? What it says is, here look at what a decision has to say. What it says is, when you find legislation following a continuous practice and repeating the very words on which that practice was founded, it may perhaps fairly be inferred that the legislature, in reenacting the statute, intended those words to be understood in their received meaning. And perhaps it might be argued that the inference goes stronger with each successive reenactment. So when earlier the explanatory memorandum said that it was to prevent money laundering and to act as a counter evasion mechanism, can you say that today when 56(2)(10) is using the same phraseology as the earlier provisions, and in fact it is borrowing some of the definitions which was already there in 56(2)(7) or 7A, the explanatory memorandum or the intent which prevailed then is as equally intended even behind 56(2)(10). And why is the explanatory memorandum important? It is important to understand why the provision was introduced, what is the type of mischief that the provision has seeks to plug, and it may so happen that you have entered into some genuine transaction where you have not committed any such mischief. You can try to argue that the provision should not apply to you. Some examples where 56(2)(10) can cause hardship can be, say for instance, Serum is purchasing shares of another unlisted company, and because of some regulatory restrictions, Serum just cannot afford to pay what is the rule 11-year price. The fair value of that company is much lower, and to that extent what it can afford to pay is it can only afford to pay the fair value of those shares. It cannot, it is regulatory, even from a regulatory perspective, it is not possible to pay a higher amount because the regulator won't permit you. In such a case, you can say that there is no abuse which is involved. Or for instance, if you are purchasing immovable property and because of some event, say for example demonetization came in, and because of demonetization the commercial value of the immovable property fell below the stamp duty value, you can try to say that look, there is no abuse which is involved, there is no evasion or there is no money laundering which is involved, and therefore can you say that the provision is not applicable? And this is only by way of an argument. We will try to understand this. We may perhaps understand this in more detail in the coming sessions. With this, we will now see what is the some aspects which are relevant to the charge. So 56.210 says it is a charging provision and therefore it requires a very strict construction. In absence of section 56.210, if there was any gift which you received or there was any savings in the purchase price, then this is not to be treated as your income. What you save in terms of savings in purchase price is not your income. Unless in absence of a specific provision, this amount is not chargeable in the hands of the recipient. So being a charging provision, it requires very strict construction. You will have to evaluate before coming to a conclusion that the provision is applicable. You will have to evaluate, is the recipient or the giver a person as defined in section 231. So where any person receives from any person or persons. So both have to be persons as defined in section 231. Then you have to say, is there a receipt of sum of money or property or immovable property or any property during the previous year? So receives in any previous year any sum of money. What this provision means is that in the previous year, which is relevant to the assessment year, there has to be a receipt of any sum of money. If the receipt does not happen in that previous year, then it is not chargeable to tax insofar as the income of that previous year is concerned. So you have to see whether there is a receipt. Then you have to see whether what you have received is a sum of money or a specified property. Then you also have to see whether the receipt is without consideration or for inadequate consideration. Now to supplement the charge, section 224(17)(a) was introduced, which said that the definition of income was expanded to include any sum of money or any value of property received, which is referred to in section 56.210. So even the scope of income has been expanded to create a charge in respect of this fictional sum, because this is notional taxation. So 56.210, additionally, what 56.210 adopts the same definitions and valuation norms which were prescribed earlier for 56.2.7 or 7A. After the introduction of 56.210, there was some change insofar as the valuation norms were concerned, insofar as unquoted equity shares are concerned. So when you are receiving equity shares, when an individual or an HUF is receiving unquoted equity shares, the valuation mechanism or the valuation rules were changed, and we will understand what was the change in the later slides. Then you have section 49.4. 49.4 says that if you say, for example, if you have received jewelry as a gift, and that jewelry, if you are transferring at a future date, what it says is the amount which was taxable in your hands under 56.210 when you received the jewelry, that value will become allowable to you as a cost when that piece of jewelry is sold by you. So what it says is, when a capital gain arises from the transfer of jewelry, the value of which has been subject to income tax under 56.210, the cost of acquisition of such jewelry shall be deemed to be the value which has been taken into account for the purposes of 56.210. So it is in a way a measure to avoid double taxation. You have already paid tax on notional with reference to notional income, so that is added to your cost and allowable as a reduction as and when you transfer the gifted asset. Then another important point to note is that 56.210 is under the head of income from other sources. It is under a residuary head. So if you find that there is a benefit which you have received, say for example an employee is receiving shares as ESOP, it is already subject matter of taxation under 17. what is already taxable under other heads cannot come up for tax, cannot be a subject matter of evaluation for 56(2)(10). Say if you are carrying on a business or a profession, and if you are receiving any benefit in course of that business or profession, then that is already taxable under 28(4). There is no need for you to evaluate section 56(2)(10) insofar as that is concerned. With that, now let us move further. So as I said, person has to be any person who is receiving, for instance, the recipient has to be a person as defined in 231. So it includes, as I said before, it includes a listed company such as Reliance. It includes AOP BOI. AOP BOI was earlier not covered under the gift taxation provisions. They have now been brought under the scope. Then you have a foreign company whose poem is in India. You have a foreign company whose poem is outside India. Say Amazon, we said Amazon is purchasing shares of Future Group. Amazon will have to evaluate 56(2)(10). So this is what is the wide nature of the provision. Then going further to what is the meaning of receipt. So it is very important that there should be a receipt insofar as 56(2)(10) is concerned. Let us see how received is defined in the dictionary and in terms of legal sense. The commentary of Kanga and Palkhiwala, it says that the word receives implies two persons, the person who receives and the person from whom he receives. So there have to be two persons, and so there has to be a giver and there has to be a receiver. Now in a case of fresh issue of shares, a question always arises that can you say that the person who is subscribing to the shares has received the shares from the company, because the shares come into existence only for the first time when they are allotted by the company. Before that, the shares were never into existence. Nobody was owning the shares. So can you say that the provision is applicable to a case of a fresh subscription to the shares of a company? There is a raging controversy on this issue, and you will come to know that we will understand that in more detail in the subsequent sessions. Then this is insofar as the first meaning is concerned. Second meaning says to receive means to get by a transfer. Again, a transfer implies that there has to be a giver on the other hand and there has to be a receiver on the other hand. So here the meaning of the word transfer refers to transfer as per general law. It does not refer to the extended meaning of the term transfer as per section 247. So when it is receipt is a flip side or a counter of transfer. So if you, when do you say you have received? If the other person has transferred his property, you can say that you have received the property. So let us say for now income from other sources, for 145(1) says that income which is chargeable under the head business or income from other sources shall be computed either in accordance with cash or mercantile system of accounting regularly employed by the SSE. So will you apply if the company is following mercantile system of accounting and it has purchased some shares? The shares are not yet received insofar as in the company's name, but the company has given the advance, it has entered into an agreement, substantially the deal is over, and you may find that in the books the company records the shares as an asset, or it says that there is a right to receive the shares in the books. Can you say that 56(2)(10) is to be applied? The answer may be perhaps no, because the section says that the person has to receive. It does not say that the shares are receivable. So received is different from receivable, and Supreme Court in the case of CIT versus Moon Mills emphasized on the distinction between received and receivable. In the context of such a fictional provision, where what is received is treated as income, you cannot expand and create another fiction to say that whatever is receivable should be your income. With that, going to the next point on section scope of interplay between section 5(2) and section 56(2)(10). So section 5 supplements the charge. Section 4 is charging every person in respect of his total income. And section 5 defines what is the scope of total income. Insofar as residents are concerned, worldwide income of that resident is chargeable as per section 5. It is not necessary that there should be a receipt in India, income accruing in India, income accruing outside India, receipt in India or receipt outside India. Insofar as a resident is concerned, worldwide income is taxable. Say for example, if Bill Gates, who is a resident of US, is gifting money to Narayan Murthy, who is a resident of India, what will the provision say? If you read 55 to with section 56 to 10, the provision will say that regardless of whether Narayan Murthy is receiving the money from Bill Gates, receiving the gift of money from Bill Gates, it is received within India or received outside India, this gift is taxable in the hands of Mr. Narayan Murthy. Similarly, when it is shares of a foreign company, for Narayan Murthy, when issue may arise as to whether, say for example, if Bill Gates is gifting shares of Microsoft USA to Narayan Murthy, again you may have to, it is taxable in the hands of Narayan Murthy, because regardless of whether the shares are received in India or received outside India, it is taxable in the hands of the individual who is a recipient, who is a resident of India. Now when you come to section 5.2, which defines what happens when the recipient is a non-resident. We took an example where recipient is a resident, where the recipient was Mr. Narayan Murthy. Now assume that the recipient is a non-resident. Say Bill Gates is now gifting money to Warren Buffett, and Bill Gates is also outside India, and Warren Buffett is also outside India. Can you say that the income is taxable, gift is taxable in the hands of Warren Buffett? So what section 5.2 says is, subject to the provisions of this act, the total income of any previous year of a person who is a non-resident, which is Warren Buffett, total income of Warren Buffett includes all income from whatever source derived, which is received or deemed to be received in India in such year by or on behalf of such person. The requirement here is income from whatever source derived, which is received or deemed to be received in India. So when Bill Gates is gifting money to Warren Buffett, can you say that the income is received in India? The answer is perhaps no, because Warren Buffett was outside India. The check was handed over outside India. It is received outside India. Then let me tweak the facts to say that both are on a visit. Bill Gates and Warren Buffett both happen to be in India, coincidentally happen to be in India when the gift of money happens. They are attending a conference and there is a gift of money which happens in India. Now, in this case, the check is exchanged in India, where Bill Gates is handing over the gift of money to Mr. Warren Buffett, and they both are sitting in India. Now, in this case, the income is received or deemed to be received in India, and you may perhaps say that in the hands of Warren Buffett, now this income can become taxable. So this here you may, so insofar as we understand, so far we covered gift of money. Now if we understand gift of shares of an Indian company, say Bill Gates is owning shares of an Indian company, say Microsoft India, and Bill Gates gift the shares of Microsoft India to Warren Buffett. Can you say that this income is taxable in India? Both are outside India when the gift happens, but what is gifted is the shares of an Indian company. Can you say that the receipt is in India insofar as the gift is concerned? This is an issue. I am only touching the tip of the iceberg. You have a devoted session insofar as this is concerned. Ganesh sir will take you through the nuances. What is the location of receipt? When do you say that the receipt has happened? Is the receipt in US or is the receipt in India? These are some issues to which we can look forward to answers in the devoted session. Now going forward to section 918. Section 918 was introduced by the Finance Act 2019. Section 918 says that income deemed to accrue or arise in India includes income arising outside India being any sum of money referred to in 224(17)(a) paid on or after 5th July 2019 by a resident to a non-resident or a foreign company. So it is any sum of money referred to in 224(17)(a). What is referred to in 224(17)(a)? It says that any sum of money referred to in 56(2)(10). So it says that what is referred to in 56(2)(10) is any sum of money received without consideration. So what it says is that if there is any sum of money which is gifted by a resident to a non-resident. Now we say ulta, Narayan Murthy is gifting to Bill Gates and the gift is happening outside India. Now if Narayan Murthy is gifting sum of money to Bill Gates, who is a non-resident, in the hands of Bill Gates, you would have said 56(2)(10) is not applicable because the receipt is not in India, the receipt is outside India. Now because of 918, this provision, you can no longer take this argument. Now it now says that in the hands of the non-resident, which is Bill Gates, this sum of money is deemed to accrue or arise in India. So by virtue of a specific charging provision, because a resident has gifted a sum of money, it is chargeable in the hands of the non-resident, even if it is received outside India. So then what we examine is, here the subject matter of gift is only a sum of money. It does not say sum of money or a property. So if an Indian resident is gifting us property, say shares, to a non-resident outside India, then that gift, assuming this receipt were to occur outside India, it is not covered within section 918. So now you have come to a conclusion. Say for instance, now you come to a conclusion that 918 says that it is chargeable now in the hands of Mr. Bill Gates. The amount which he has received, sum of money which he has received from Narayan Murthy, it is taxable in the hands of Bill Gates. The matter does not end there. Now you have to see the treaty to see whether a relief is available. So these are some nuances to say treaty to see whether any relief can be claimed by Mr. Bill Gates in respect of the sum of money. So these are some nuances which we can look forward to in the detailed sessions. Now moving forward, we are going to section, we are understanding what is the scope of sum of money. So sum of money covers receipt of cash or foreign currency. In case of H.S. Sri Rama Verma, the Supreme Court said that the expression sum means any indefinite amount of money. So the sum itself is sufficient to capture within its fold sum of money. But now we have a specific provision which says it is sum of money. So anything which you have received in kind, which is representing money's worth, is not covered insofar as the first clause A is concerned. Insofar as clause A is concerned, it is only sum of money. What you are receiving in kind is not covered insofar as clause A is concerned. Then it also says that sum of money received without consideration. Thus, when you say immovable property or specified property, in addition to without consideration, you also have for a consideration which is less than the fair value or the stamp duty value. So in addition to without consideration, you also have for inadequate consideration. Whereas for sum of money, it only says sum of money received without consideration means sum of money received as a gift. If you receive a sum of money for inadequate consideration, it is not covered in 56(2) in clause A of section 56(2)(10). Say for instance that if I enter into a contract with Mr. Chirag to say that I will purchase some goods of Mr. Chirag. Now, when the time Mr. Chirag has already manufactured the goods relying on my order, and ultimately when the date comes to take delivery of the goods, I back out and say that no, now I cannot purchase the goods. You take some monetary compensation from me, but now Chirag bhai, I cannot purchase the goods from you. So due to the loss or the detriment which has happened to Chirag Bhai, he is getting a sum of money. Now, keeping aside for this is in any case it is chargeable as business income, but keeping that aside, taking this as an example, let us see whether 56(2)(10) can apply or not apply. So it says is a sum of money received without consideration. So for Chirag Bhai, when he is receiving sum of money from me, it is not without consideration, because this money, this compensation is paid for the breach of the contractual commitment which was made by me. So it is not without consideration. It may be for inadequate consideration, because the damage which has or the loss which has been suffered by Chirag Bhai may be less or it may be more than the sum of money that I am paying or the compensation that I am paying. But that inadequacy or adequacy is not, perhaps not a subject matter insofar as clause A is concerned. Now moving forward to what is the amount which is taxable insofar as sum of money is concerned. So what it says is, in particular and without prejudice to the generality of the provisions of subsection 1, the following incomes shall be chargeable to income tax under the head income from other sources. Namely, where any person receives in any previous year from any person or persons any sum of money without consideration, the aggregate value of which exceeds 50,000 rupees, the whole of the aggregate value of such sum. So what it says is, if you are receiving a sum of money as a gift whose value exceeds 50,000, and for this you have to see the aggregate value. So I can receive, so if I am the individual who is receiving a gift, Virag is gifting to me 49,000 and Chirag Bhai is also gifting to me another 49,000. What I have received an aggregate value of 98,000 which exceeds 50,000 rupees. So in my hands, the whole of 98,000 is taxable. I can't say that I will claim exemption out of 98,000, I will claim exemption for 50,000 and only balance 48,000 is taxable in my hands. Moment it exceeds 50,000, all the persons combined, then the whole of the amount is taxable in the hands of the recipient. This is insofar as sum of money is concerned. Now, you may, so there might be some very interesting situations in real life where you may say that if you have received a gift of money of 51,000, the 1,000 rupees that you put as shagun might end up punishing the other person because he may have to pay tax on that 51,000 at 30%. As compared to that, if you had given him 49,000, he would have been grateful to you. Now, then when we come further to what is scope of any property other than immovable property. For immovable property, there is a lot of debate and we will not touch upon that as to what is the scope of immovable property, whether it covers, whether it is restricted to stock in trade or it covers a capital asset, whether it is restricted to capital asset or it covers a stock in trade also. What is the scope of immovable property, whether it covers only land or building or can it cover anything more? These are all issues which you can find answers in the detailed session. We will not be touching upon those issues today. Moving further to what is the scope of any property. Any property, if you receive without consideration or for a consideration which is less than the aggregate fair market value, then it is taxable in your hands. And for this purpose, property means the following capital asset of the SSE. So here, if I were to read the definition in 56(2)(10), it says that the expression property shall have the same meaning as assigned to it in clause D of explanation to clause 7 of section 56(2) and shall include a virtual digital asset. So clause D of explanation to 56(2)(7) defines the term property as property means the following capital asset of the SSE, namely shares and securities, jewelry, archaeological collections, drawings, paintings, sculptures, any work of art or bullion. So you have, these are the specified properties which if you receive as a gift or you receive for inadequate consideration, then it is taxable in your hands. For virtual digital asset, there is an issue as to whether virtual digital asset does it cover a virtual digital asset which the recipient is holding as a stock in trade? Because it says when the term 56(2)(10) defines the term property, it says virtual digital asset is included within the definition of the term property. But insofar as the term property is defined, their virtual digital asset is not included, and the restriction as to restricting the scope to a capital asset you find only in clause D. Virtual digital asset is not covered in clause D. So can you say that even for virtual digital asset the scope is restricted to capital asset? Or if you are receiving a crypto and which you are holding as stock in trade, crypto which is received as a gift, which is held by you as a stock in trade, can you say that the provision is not applicable? This is also again an issue. Then what do we see? Which are the properties which are not covered specifically in 56(2)(10), where you can freely exchange gifts and it is not chargeable, it is not covered by 56(2)(10). You can give motor car, you can get a watch, you can get an intangible asset, you can get a benefit in the form of an interest-free loan. Interest-free loan, in any case, insofar as the loan is concerned, it is backed up by consideration because you have to repay the loan. But nevertheless, there is a benefit because you are getting it interest-free, but it is not taxable under 56(2)(10). Then you have a business undertaking. For a business undertaking, there is an ambiguity as to whether 56(2)(10) can apply or not apply. Specifically, when the business undertaking comprises of something like immovable property or shares and securities or any of these particular specified properties, then can you say that if you are receiving a business undertaking, can you say that the provision is applicable? Again, it is an issue which on which we will not be deep diving today. Then it is important to understand that if you are receiving a watch, it is not covered. But if you are receiving a diamond studded watch, say for example, if your diamond is studded in that particular watch, then it might be taxable because it gets covered within the definition of the term jewelry. Because the definition of the term jewelry under section 214 says that jewelry includes precious or semi-precious stones, whether or not set in any furniture, utensil or other article. So this was just as a caution point. Now when we come to securities, what is the scope of securities? And here, unlike, there are some provisions of the Income Tax Act where the term security is specifically defined. Insofar as section 56(2)(10) is concerned, the term security is not specifically defined anywhere. It just says shares and securities. But so far as the rule is concerned, the valuation rule says that securities shall have the same meaning as assigned to it in section 2H of Securities Contracts Regulation Act. So now under Securities Contracts Regulation Act section 2H, it says that securities include shares, scripts, etc. or other marketable securities of a like nature. So here the courts have interpreted the term security to mean that the security should be marketable, and if it is only if it is marketable, it is treated as a security. Insofar as shares of a private limited company are concerned, the court says that the shares of a private limited company are not freely transferable. It is subject to restrictions mentioned in the Articles of Association, and therefore the shares of a private limited company, although the term security includes the shares, it is not, because it is not marketable, the shares of a private limited company are not securities. So insofar as 56(2)(10) is concerned, whether the scope of the term securities is restricted to securities which is defined in section 2H of SCRA. Because the valuation rule, when you come to the determination of fair market value of securities, there the rule says that you have to read it as per 2H of SCRA. Whereas the primary enactment is silent. So here an issue arises as to whether the scope of the term securities covers any and every security, or do we understand it as per the dictionary meanings to say that any security is covered, or do we restrict it to something which is understood, which is understood as a security in terms of SCARA. So insofar as shares are concerned, shares of a private limited company, this debate does not arise because the shares are specifically covered here. So you need not go to the term securities, you need not go into this issue. So shares of a private limited company, equity or preference, they are covered here. But insofar as the rights in the shares are concerned, say for example, there is a private limited company who is issuing a rights, who is making a rights issue at a discounted price. Now, keeping aside the controversy as to whether the rights issue is fresh issue or not, and keeping aside that controversy, assuming there is a rights issue and this rights entitlement is transferred by one member to another member. Now, when this transfer of rights entitlement happens, and this rights entitlement is entitlement to subscribe to shares of a private limited company, can you say that the term securities is confined to securities as per section 2H of SCRA? It is not shares because the rights entitlement is not yet subscribed, it is not shares. Can you say that it is securities? And for this purpose, will you restrict the term security to section 2H of SCRA? This is also an issue where we will have a specified session, we have a devoted session on shares and securities, where you will understand all these nuances. Then what it says is, you have to receive sum of money or specified property without consideration or for inadequate consideration. So what the term consideration is not defined anywhere in section 56 to 10. So when you come to, it is neither defined in 56 to 10 nor in the Income Tax Act or the Gift Tax Act. So as per dictionary, consideration means any compensation or any quid pro quo. As per section 2D of Indian Contract Act, consideration is defined like this, that when at the desire of the promisor, which is the transferor, the promisee, which is the transferee, or any other person has done or abstained from doing, or does or abstains from doing, or promises to do or abstain from doing something, such act or abstinence is or promise is called a consideration for the promise. So if the transferee has done something, or he does something, or he promises to do something, then it is called as a consideration. So when you refer to the commentary says that consideration for a promise may mean, commentary to the Indian Contract Act, consideration for a promise may consist either in some benefit conferred on the promisor or detriment suffered by the promisee. So if the transferee is passing on some benefit to the transferee is passing on some benefit to the transferor, say he is paying a sum of money, then whatever he is paying is consideration. As compared to that, it can also mean, as per commentary, it can also mean any detriment which is suffered by the transferee. So this detriment is suffered at the desire of the promisor, or it can be both. Now say for example, if to understand the example of a detriment, assume that the subsidiary is transferring a capital asset to a holding company, and the holding company holds 99% shares of the subsidiary, and there is a capital asset which is transferred for inadequate consideration by the subsidiary company to the holding company. Now the fair value of that asset is say 100 lakhs, and it is transferred for only say 1 lakh. Now what is the consideration which the holding company is paying? The actual consideration is 1 lakh. Now is it restricted to 1 lakh, or can it also include a detriment which is suffered by the transferee? Now in this case, the transferee, which is the holding company, because an asset is going out from the books of the subsidiary at a value of only 1 lakh, while the fair value of that asset is 100 lakh, but it is going out only for 1 lakh, there is a dent or there is a detriment which is suffered by the holding company of the value of shares of the subsidiary. The interest of the holding company, insofar as the shares of the subsidiary are concerned, the value of those shares will go down because now the subsidiary is only charging 1 lakh for an asset which is valued at 100 lakhs. Can you say that this detriment is also a consideration? This is something for you to ponder upon. We may cover it in the subsequent sessions. This is something which you may have to evaluate in further detail. In fact, Indian Contract Act itself, there is a wide commentary on what is consideration, what is inadequate consideration. And today, due to lack of time, we may not be able to cover that. Then we will go further to understand. Insofar as sum of money is concerned, we understood what is the taxable value. We will understand what is the taxable value for immovable property and specified property. What it says is, the following incomes shall be chargeable to tax under the head income from other sources. And here, where a person receives any immovable property without consideration, stamp duty value of which exceeds 50,000 rupees, what is taxable is the stamp duty value. Now, if the stamp duty value is, if I have received a gift from Mr. Chirag, the stamp duty value of that immovable property is 49,000. And in addition to that, Mr. Virag is also giving me another gift of another immovable property whose stamp duty value is also 49,000. Will you club both of them? Answer is perhaps no, because the section says that for immovable property received without consideration, stamp duty value of which exceeds 50,000, means stamp duty value of the immovable property that you are receiving should be more than 50,000. Then what is taxable is the stamp duty value. Now, insofar as the individual property is concerned, the stamp duty value is less than 50,000. Whereas if I were to, instead of immovable property, if I were to receive jewelry from Virag and Chirag, where the jewelry value, one piece of jewelry is 49,000 and another piece of jewelry is 49,000, both are received from two different persons, there the section says that if I am receiving it without consideration, the aggregate fair market value of which exceeds 50,000. So if the aggregate value exceeds 50,000, in this case it does, then the whole of the aggregate fair market value, which is 98,000, will become taxable. I cannot say that I will reduce the taxable value by 50,000. The whole of it is taxable once you exceed 50,000. Whereas insofar as immovable property is concerned, it is evaluated separately qua that immovable property. Moment the fair value, the stamp duty value exceeds 50,000. So suppose if Virag has gifted me an immovable property and the fair value of that is 51,000, then the entire stamp duty value, which is 51,000, will be taxable in my hands. This is moving forward to some exclusions in 56(2)(10). The most popular exclusion being exclusion for a relative. It is very important to note what this provision says is, this is introduced by way of a proviso to 56(2)(10), which says that this clause shall not apply to any sum of money or any property received from any relative. So if I am an individual and I am receiving any property from my relative, then this clause shall not apply. So this receipt can be without consideration or it can be for inadequate consideration. What it says is that this clause shall not apply if I have received it from my relative. It says that relative means in case of an individual, which is me who is receiving the gift, in case of an individual, spouse of the individual. So for me, my spouse can give me a gift, it is not taxable in my hands. Similarly, my brother or my sister can give me a gift, it is not taxable in my hands. My Sala or my Sali can give me a gift, it is not taxable in my hands. My Chacha or my Mama or Tau, he can give me a gift, again it is not taxable in my hands. It says in case of an individual who is receiving the gift, who is the relative? Relative is the brother or sister of either of the parents of the individual, which is brother of my parent, which is brother of my father, gives me a gift, then it is not taxable. So if my chacha or mama gives me a gift, it is not taxable in my hands. Then it also said that if it also includes lineal ascendant or descendant. So I can receive from my dada or dadi, nana or nani, it is not taxable in my hands. I can say I can receive it from my sas or sasur, it is not taxable. I can receive it from my bhabi or jija, that is also not taxable. So this is insofar as the scope of the exclusions are concerned for an individual. Then I go to an so here, before going to HUF, let us understand something more about individual. So received from friends, it does not qualify as for exclusion. Received from a cousin brother. So what it says is, if you are receiving it from your brother or sister, can you say brother includes a cousin brother? In Chennai tribunal decision, it said that the receipt from a cousin sister, they denied the exemption. Then the next point is important, that if earlier what I said is, assuming if my chacha is giving me a gift, I am the person who is receiving the gift of money and my chacha is giving it to me, then it says that this clause shall not apply to any sum of money received by me from any relative. And relative here means, in case of me, which is in case of an individual, the brother of my father, which is my chacha or my mama, that is exempt. So for me, when I am receiving a sum of money, brother of my father is a relative and therefore I can receive a gift from my chacha. It is not taxable in my hands. But if it is ulta, that if I am giving a gift to my chacha, can it qualify as for exemption under 56(2)(10)? What it says is, when chacha is receiving the gift from me, for my chacha, I have to qualify as a relative. This clause shall not apply to any sum of money received from any relative, and so it means that I have to be a relative insofar as my chacha is concerned. And it says that in case of an individual, which is my chacha, if in case of the individual who is the chacha, what is exempt? He can receive from his brother or his sister. So he can receive from my father. It is exempt in the hands of my chacha. But assuming I am the person who is gifting the amount, what it says is, children of the brother are not covered, or children of the sister are not covered anywhere in the definition. It says lineal ascendant or descendant of my chacha ji, but it does not say any children of the brother or sister. So I am the child of my father, and for my father the brother is my chacha, and he has to, I am not specifically covered under the definition of a relative insofar as my chacha ji is concerned. So what we are noticing here is, when I am receiving from my chacha, it is exempt in my hands. But when I am giving to my chacha ji, then that is not exempted. That is taxable. Then moving forward further to HUF. So receipt, what it says is, this clause shall not apply to any sum of money or any property received from any relative. And for this instance, relative means, in case of an HUF, any member thereof. So if an HUF is receiving any sum of money from any relative, and relative is defined here as any member of the HUF, then it is not taxable in the hands of the HUF. So HUF can receive a gift from his member, but when HUF is receiving a gift from the relative of the member, can you say that the exemption applies? There is no explicit protection here. Ulta, can you say that the member is receiving a gift from the HUF? So what it says is, here the member is the recipient. Is HUF covered anywhere in A to G? Answer is no, it is not covered. So again, it is not explicitly protected. So we will go further after these nuances. We will say that we may not delve so much into detail insofar as the other exclusions are concerned, because you are going to have a specific session which is devoted only to exclusions, where you will understand how each of the exclusions operates. So what this says is, another exclusion says that if you are receiving gift on the occasion of your marriage, it is exempt, or you are receiving a gift under a will or by way of inheritance, it is exempt. So here there is no condition that you have to receive it from your relative. You can, on your marriage, you can get it from your friend, you can get it from any non-relative, it is exempt. Similarly, under a will, if a person dies and the property is willed to a non-relative, then that is exempt in the hands of the non-relative because it has traveled under a will. Then what we have is, we have a number of transactions in section 47 which is not regarded as a transfer. One of the, to give you an example, say for instance, if an amalgamated company is receiving a capital asset from an amalgamating company, for the amalgamating company, it says section 47(6) says that a transfer of a capital asset to the amalgamated company is exempt insofar as capital gains tax is concerned. So for the amalgamating company, it is tax neutral. What happens for the amalgamated company? Say for example, if you are receiving some specified property, say immovable property of amalgamating company as amalgamation, and the stamp duty value of that immovable property is more than the value of the shares which are issued to the shareholders of the amalgamating company, can you say that the provision is not applicable? Because the benefit which is received by the amalgamating company in the form of immovable property, the stamp duty value of that is more than the value of shares which are issued to the shareholders of the amalgamating company. So this amalgamation is tax neutral, and perhaps you can say that if the amalgamation is tax neutral, it is exempted under 47 clause 9 and the provision may not apply. Then you have 47(4). 47(4) says that if a wholly owned subsidiary is receiving any capital asset from a parent, then it is protected insofar, then the parent does not have to pay any capital gains tax. So it's assuming the wholly owned subsidiary were to receive sum of money, not a capital asset, but if it were to receive a sum of money from the parent, can you say that the provision is still applicable, whether the exclusion is still applicable? Because 47(4) says it grants exemption only when the parent is transferring a capital asset to the subsidiary, wholly owned subsidiary. Whether sum of money will include a capital asset, assuming sum of money is not covered by 47(4), can you say that it is still covered by clause 9 because it is not because here the language says that any sum of money or any property. So if the subsidiary is receiving, wholly owned subsidiary is receiving a sum of money from the parent, then it is a transaction not regarded as a transfer and therefore it is exempt. Again, this is also an issue. Then we go further to then we go further to clause 10, which is granting exemption insofar as the settlement of property in a trust is concerned. So what this says is, provided that this clause shall not apply to any sum of money or any property received from an individual by a trust created or established solely for the benefit of relative of the individual. So who has to be a recipient? Here it defines the recipient has to be a trust. Who is the giver or who is the donor? The donor is the individual who is settling the asset into the trust. So an individual is settling an asset into a trust where the beneficiaries of the trust are the relatives of the donor, then it is not taxable in the hands of the trust. This is what the provision says. Now there is an interesting nuance, because it says established solely for the benefit of relative of the individual. So here the individual may refer to the person who is the donor. So the beneficiaries have to be a relative of the donor. Now earlier what we now examined is that when I am gifting a money, so if we were to take an example here, suppose A and B are brothers, and A is gifting 1000 to Mr. B directly. It is exempt in the hands of Mr. B because they both are brothers. Suppose if A were to gift that money, settle that money in a trust, which is solely for the benefit of B, then Mr. B is a relative of Mr. A, and therefore it may get covered by within the scope of this exclusion. Now, assuming the beneficiaries are not only Mr. B, but the beneficiaries are Mr. B's children also. So I just said in the earlier slide that for my Chachaji, I am not a relative. For me, when I am receiving, Chachaji is related to me, he qualifies as a relative. But when I am examining from the perspective of my Chachaji who is receiving, then for my Chachaji, I am not a relative. So here what it says is, the person has to be for the benefit, the trust has to be settled for the benefit of the donor. So here when Mr. A is settling a trust for the benefit of Mr. B's children, then Mr. B's children are not relative of Mr. A. They are not relative from the perspective of the donor. So therefore, can you say that the section is not applicable? Now, when you give directly to Mr. B's children, it is protected under clause 1. Because Mr. A is giving directly to Mr. B's children, he is directly giving to the nephew or the niece, then it is exempt, because in the hands of the nephew or the niece, relative definition covers chacha or mama, and it is exempt in the hands of the nephew or the niece. But when the same money is settled in a trust, whose beneficiaries are the nephew or the niece, then it is not protected, because for the individual who is the donor, the nephew or the niece is not a relative. This is an interesting nuance which I thought is worth highlighting. Now, with this we close on 56 to 10. Moving forward further to section 50C. So section 50C says that where the consideration received or accruing as a result of the transfer of a capital asset, being land or building or both, is less than the stamp duty value, then the stamp duty value will be deemed to be the full value of consideration received or accruing as a result of such transfer. So what it says is that if there is a land or a building which you are transferring, which you are holding as a capital asset, which you are transferring, and the consideration which you are receiving or accruing as a result of that transfer is less than the stamp duty value, then the stamp duty value will be deemed to be the full value of the consideration. So this provision was introduced by the Finance Act 2002, and the intention behind the introduction of this provision is to curb tax evasion and proliferation of black money in real estate transactions, where you understated your consideration. When you said that you are selling a property, the stamp duty value of that, the fair value of that property can be 150 lakhs, but the agreement value is only 100 lakhs. So you are understating the consideration. There is a case of tax evasion, and in order to curb this tax evasion, there is a specific provision which says that if the consideration which you are receiving is less than the stamp duty value, then the stamp duty value for the purposes of section 48 will be deemed to be your consideration. So here there is no opportunity insofar as the text of the provision is concerned, there is no opportunity which is granted to prove that what you have received is nothing more than 100 lakhs. Suppose if you are transferring for 100 lakhs and the stamp duty value is 150 lakhs, you may actually not have received on the balance 50 lakhs, but there is no provision, there is no opportunity which is granted in the section. The section does not require the assessing officer to look into whether what is the actual consideration that you have received. It just arithmetically says that if the stamp duty value is more than the consideration, the stamp duty value is taxable. Now it may so happen that in genuine cases where the actual consideration is less than the stamp duty value, there can be a distress sale say for a, or there the purchaser could be somebody like a government or a PSU, where you would have agreed to sell at a lower price. Now in such a case, even if the purchaser is somebody who is of a repute, still for you, when you are selling the property, there is no benefit, there is no exclusion from 56(2), there is no exclusion from section 50C. Also, it is possible that the stamp duty value may have no correlation with the fair market value. In the recent Delhi Tribunal decision in case of Young Indian gives us many reasons as to why the stamp duty value can be more than the fair market value. So stamp duty value is published with reference to the area in which the property is located. There might be some specific advantages or disadvantages for that property associated with that property, where that property is located. It is located near the slums, or there is a lot of traffic. Stamp duty value is agnostic to all these cases. It does not give any discount insofar as these situations are concerned. So it may so happen that your actual value, fair market value, is far lower than the stamp duty value. Still, the provision may end up taxing you with reference to the stamp duty value. So let us give some legislative history behind this provision. So before section 50C was there on the statute, we had section 52(2), section 52 subsection 2, which was introduced in 1964 and which applied till 1988. As per section 52 subsection 2, if in the opinion of the assessing officer, the fair market value of the capital asset exceeded 115% of the agreement value, then the fair market value could be adopted as the consideration for computing capital gains. Now, Supreme Court in KP Varghese held that when the assessing officer could resort to this provision and substitute the fair market value as the consideration only if the assessing officer is able to demonstrate that the assessee has realized something in excess of the agreement value. In other words, the assessing officer should be able to demonstrate that the agreement value has been deliberately understated. Where there is no evidence to indicate that the actual consideration received is more than what you have disclosed in the agreement, then as per Supreme Court, subsection 2 of section 52 may not apply. Now the Supreme Court said this, even section 52 also never had any specific provision to say that the agreement value, to require the assessing officer to prove that you have received something extra more than what is disclosed in the agreement. Despite in absence of a specific provision, Supreme Court said that the AO can apply it only if you have deliberately understated your consideration. So the Supreme Court read down the provision to restrict the applicability to cases of tax evasion with a view to avoid harsh and absurd consequences insofar as the bona fide and honest taxpayers are concerned. And which can be such bona fide and honest taxpayers? I gave an example of demonetization, where the stamp duty values were not revised despite the fair market value of the properties falling to a great extent because of demonetization. Then after section 52(2), we have another provision which came to be inserted in the statute, which is chapter 20C. Chapter 20C said that in case of transfer of immovable property, if the fair market value exceeds the agreement value and the agreement value has been understated with the object of tax evasion, then the central government has a preemptive right to compulsorily acquire the immovable property from you at the agreement value. Unlike section 52, where there was no requirement in the text of the section for the assessing officer to prove that there has been an understatement of consideration, in chapter 20C, there was an onus on the taxpayer to demonstrate that what he has received is not more than what is stated in the agreement. Now this provision was withdrawn in 2002 and 50C was introduced by Finance Act 2002. Some specific features of this provision are that it applies only when consideration is received or accruing as a result of the transfer. Say for example, if you have transferred a property as a gift and you have not received any consideration, then in any case it is exempt under section 47. It is not subject matter of section 50C, and there is no consideration which is received or accruing, and therefore section 50C is not applicable. Then the subject matter of the transfer insofar as 50C is concerned should be land or building or both. Now let us understand there are some provisions for 50C, some safeguard mechanisms under 50C which are as equally relevant insofar as 56 to 10 is concerned. So 50C applies with reference to the seller of the land, and 56 to 10 will apply with reference to the purchaser or the receiver of that land. For what does the proviso say? The first proviso says that, assuming an example where today I am negotiating to sell a property to Mr. Chirag, and there is an agreement that today considering the fair value of the property, which is say 100 lakhs, I am entering into an agreement to transfer this property for 105 lakhs. So Mr. Chirag has to pay 105 lakhs to me, and I am the seller of that property. For some reason, the agreement is signed today, the consideration is decided as of today of 100 lakhs, the stamp duty of 105 lakhs, the stamp duty value is 100 lakhs, and it may so happen that for the actual sale to happen, it may take 6 months, it may take 8 months, it may take 1 year, because there are a lot of formalities which are involved, due diligence is involved. There in terms of making an application for lower TDS, there can be anything for which there might be a delay in registering the sale. So agreement for sale is signed as of today to transfer the property for 105 lakhs, and the stamp duty value is 100 lakhs. As of today, I don't have any worry of section 50C, but it may so happen that later, as on the date, suppose assuming there is a delay of 8 months, and after 8 months I am able to transfer the property. After 8 months, I find that now there is a revised stamp duty value which has been notified, and that stamp duty value is 115 lakhs. So what does it say? I might have to pay tax with reference to the differential of 10 lakhs, which is the excess of stamp duty value of 115 lakhs over the actual consideration which I am receiving of 105 lakhs. This is fully unintentional, because when I had negotiated and when I had fixed the consideration, at that point of time the value was value was lesser than the consideration. So the subsequent fluctuation after the consideration is fixed, the subsequent fluctuation in the stamp duty value may be not wholly within my control, and therefore the provision says that when the date of registration is different from the date of entering into the agreement, and the stamp duty value has increased as compared to the date of entering into the agreement, then the stamp duty value on the date of the agreement may be considered for computing the full value of consideration. So in my case, I can compute my capital gains using 100 lakhs, which was the stamp duty value as on the date of entering into the agreement. It is not the date of entering the registration. But there is a condition for me to avail this facility. There is a condition, and the condition is that the amount of consideration has been received by way of an account pay check on or before, or part thereof has been received by way of an account pay check or banking channels on or before the date of the agreement for transfer. So this is with a view to avoid the backdating of the agreement for transfer, to ensure that an agreement for transfer has been entered into on a prior date, to check whether you have received any consideration or not. Then there is a provision which makes reference to the departmental valuation officer. So where the assessee claims before the assessing officer that the fair market value as on the date of transfer is less as compared to the stamp duty value, then the assessing officer can refer the valuation to the departmental valuation officer. And where the value which is determined by the departmental valuation officer is more than the stamp duty value, as a relieving provision, it is only the stamp duty value which is adopted. Whereas where the departmental valuation officer adopts a value which is less than the stamp duty value, then the value which is arrived at by the departmental officer is binding. AO cannot independently determine the fair value. Then what we learn for 50C is as equally applicable insofar as 50CA is concerned. For 50CA, it was introduced by way of Finance Act 2017. 50C refers to land or building or both. 50CA refers to share of a company other than a quoted share. For 50C, what I adopt is the stamp duty value. For 50CA, what I adopt is the book value as per Rule 11UA. And Rule 11UA, we will try to, Rule 11UAA and Rule 11UA, we will try to learn in the subsequent slides. So what it says is shares of a company other than a quoted share. So it can mean even shares of foreign company, it can mean equity shares, it can mean even preference shares. And there is a definition of a quoted share, and there are some conditions which are attached to it. So let us now compare and try to understand what is the interplay between 50CA and 56(2)(10). So when you are selling to a relative, at that point of time, section 50CA can still apply. There is no exemption when you are selling to a relative. But in the hands of a relative, 56(2)(10) is not applicable because he is receiving from a relative. Then if there is gift to a relative, then 50CA does not apply. Why? Because it is a gift, it is exempt under section 47. 56(2)(10) also does not apply because it is gift received from a relative. If there is a gift to a non-relative, then 50CA does not apply because gift 47(3), the provision is very wide. Even if you are gifting to a non-relative, it is exempt exempt under section 47. Moment it is exempt, section 50CA does not apply. But for 56(2)(10), in the hands of the non-relative, whatever is the gift which is received can be taxable. Similarly, you are receiving the share, if there is a transfer of a shares of a listed company, section 56(2)(10) can apply, but section 50CA cannot apply because 50CA is restricted to unquoted or unlisted shares. If the difference between the 11UA value and the actual consideration is less than 50,000, 56(2)(10) will not apply, but 50CA will still apply because 50CA does not have any limit of 50,000. What if then we will come further to safe harbor. For safe harbor, earlier there was no specific exemption insofar as based on the comparison of stamp duty value and actual consideration. Now, what the specific provision says, in order to reduce hardship to the real estate sector, for section 50CA and 43CA, what it says is, if the stamp duty value is not more than 110% of the consideration, then the consideration what you are receiving or accruing, the actual consideration will be deemed to be the taxable value. It will not be the stamp duty value. So basically, this is the provision which allows you to bump up the consideration from 100%, you can bump it up to 110% and compare it with the stamp duty value. If the stamp duty value is not more than 110%, then 50C is not applicable in the hands of the seller, and in the hands of the buyer, 56(2)(10) is not applicable. Let us take an example. Say 100 lakhs is the consideration which is received or accruing, and the stamp duty value is 109 lakhs. So earlier I used to compare 100 lakhs and 109 lakhs, and in such a case, section 50C could have applied. But now I have to compare 110% of the consideration, which is 110 lakhs, I have to compare with 100 lakhs. And here I now find that the stamp duty value is less than 110 lakhs, and therefore 50C is not applicable in the hands of the seller, and 56(2)(10) is not applicable in the hands of the purchaser. This provision of this safe harbor is applicable only for immovable property. It is not applicable for any other property such as unquoted shares. Say for example, it is not what is there in 50C, this safe harbor is not there in 50CA. Then we will take a simple example to understand how both 56(2)(10) and 50C can have an impact for the transferor and the transferee. Say if you are acquiring a land parcel, Mr. Eco is there which has acquired a land parcel for a cost of 10 lakhs. and ACO is transferring that land parcel to BCO for 40 lakhs. 40 lakhs is the actual consideration. So for ACO, cost is 10 lakh, it is transferring at 40 lakhs. The stamp duty value is 100 lakhs. What does section 50C say? It says that the actual consideration of 40 lakhs is substituted and the stamp duty value is considered. Stamp duty value of 100 lakhs minus the cost of 40 lakhs. 90 lakhs is treated as consideration, is the capital gains which is chargeable in the hands of ACO. 90 lakhs is comprised of the commercial gain of 30 lakhs, which is 40 lakh minus 10 lakh, plus a notional gain of 60 lakhs, which is with reference to the stamp duty value. So in the hands of ACO, ACO will pay tax with reference to 90 lakhs, and BCO also has to pay notional tax under 56(2)(10) because BCO has purchased for an actual consideration of only 40 lakhs, whereas the stamp duty value was 100 lakhs. So for BCO, entire 60 lakhs is taxable under income from other sources. So we find that 60 lakhs the notional gain is taxable in the hands of the seller as also in the hands of the purchaser. And tomorrow when BCO sells that piece of land, he can claim a cost of 100 lakhs under 49(4). So very broadly, we will touch upon Rule 11UA. Rule 11UA has a valuation mechanism. When you are receiving a specified property such as jewelry, artwork, etc., there are specific rules which are prescribed. For virtual digital asset or for bullion, the rules are not yet prescribed. For quoted shares and securities, it is the price which is quoted on the stock exchange. For unquoted shares and securities, the price which will unquoted shares and securities other than unquoted equity shares, the price in the open market price as certified by valuation report of merchant banker or chartered accountant. So these values, suppose for example, if I am an individual and I am receiving jewelry as a gift from a friend, then what is taxable is the price which is as per the valuation report of the registered valuer. Similarly, if I am receiving unquoted shares as a gift, if I am receiving unquoted preference shares or unquoted securities as a gift, then it is the price which that security will fetch if it is sold in the open market. So what we find is that the commercial value is not relevant, but it is a Rule 11UA value which will be important. And but now let us examine, insofar as we said what is the value for shares and securities which are shares and securities other than unquoted equity shares. For unquoted equity shares, we will understand what is the valuation mechanism, and we will directly go to an example. In this example, you see that there is a promoter group which is holding unquoted equity shares of ACO, an unlisted company. And ACO is holding the following capital assets. It is holding intellectual property. It is holding unlisted equity shares of BCO, which is another unlisted company. BCO is holding immovable property, and it is owning shares of another unlisted company, which is CECO. Then ACO is also owning some listed equity shares in DCO. Now, if there is a transfer of shares of ACO, how will you determine the fair value of these shares for the purposes of 50 CA and section 56(2)(10). What the rule says is that I have to open up the balance sheet of ACO, and in the balance sheet of ACO, if there are any specified properties, any of these specified properties are there or immovable property is there, then what the value is to be, for those specified properties, the value has to be as defined in this table. But if there are any other assets apart from these specified properties, then I can go by the book value. This is what broadly the provision says. So now when it comes to intellectual property is not a specified property. So therefore I don't, intellectual property can be considered as the book value. If it is a self-generated intangible, then it will not at all enter into the calculation of 11UA value. Then I have listed shares of BCO. So what it says is I opened up the balance sheet of ACO and I find that there is an unlisted share of BCO sitting here. Now what it says is I have to open up the balance sheet of BCO also and to find out if BCO is holding any immovable property or specified property. If BCO is holding that, then that is the stamp duty value which has to be considered. And for immovable property, it is the stamp duty value, and for other assets, it is the specified value. So I have to open up the balance sheet of BCO when I am selling the shares of ACO. Insofar as DCO is concerned, what we find is for quoted shares and securities, it is the transaction price which is quoted on the stock exchange. So for DCO, it is I did not open up the balance sheet. I can only directly straight away adopt the stock exchange price. So I've opened up the balance sheet of ACO, and intellectual property, I am taking it at book value. BCO shares, I am again doing a separate valuation. For DCO, I am taking the stock exchange price. Now I may be holding, Mr. ACO may only holding only one share in BCO, but still the requirement of the provision is so onerous that it requires me to open up the balance sheet of BCO. And this balance sheet has to be prepared as on the valuation date, which is the date when the transfer is happening, when the shares of equity shares of ACO are transferred. There is no facility to adopt the balance sheet as on the balance sheet as on the last preceding year end. So this is what the requirement of the provision is. And look at it, it is so onerous when there is a shares which is transferred at an upper level. Look at how I have to open up the balance sheet of BCO, I have to open up the balance sheet of even CCO. And I have to also get the balance sheet audited. This is what is the requirement. But let us now, we will understand in the subsequent sessions. You have a session on Rule 11 UA also, and we will understand some further nuances and maybe some more practical solutions as to how this is to be implemented in industry. Because this provision has been there in the statute since 2017 when the rules were notified, and it continues to stay even as of today. With that, thank you very much. Thank you CTC for giving me this opportunity. And I would also like to thank others who are my colleagues who have helped me with this presentation.
Thanks,
Thank
Vinod.
you. Thank you so much, Vinod. It was really enriching, though it is just tip of the iceberg, but this tip is very wide and filled with lots of question marks. And you have very, in a brief, summarized manner, pointed out few issues, answered few questions, and raised a lot many questions, which in the course of 2 half-day seminars, we hope the speaker will throw some more light. Friends, I would like to admit that Vinod has gone an extra mile preparing for this presentation, and even over the weekend, it was an immense hard work which he had put in, which I am sure, looking at the PPT and the talk which you just heard, you all will agree. Thank you, Vinod, on behalf of CTC and the Direct Tax Committee for this wonderful session on the overview. Thank you so much. Over to you, Chirag.
Thanks, Abhitan, for the kind vote of thanks to Vinod. As suggested, this was a pre-recorded session. We would be looking forward for all the participants towards the live session that would be conducted. Looking forward for all the participations and especially various pointers which were being mentioned by Vinod. He touched upon various aspects. So we look for the solution in that forthcoming sessions. Thank you. Thanks a lot for participating.